5, 4, 3, 2, 1. Good afternoon, Quasar Markets Live. So happy to see everybody here today. I am joined, like always, by Dr. Alan Ellman, the president of the Blue Collar Investing Corporation. Dr. Ellman, how are you doing today?
Great day down here in Florida. How you doing?
I'm doing, it's not as great I'm in Boston visiting my dad for a couple of days. I have to say they have less snow than I had in Ohio, so I can't complain.
Yeah, I'm not exactly sure what you mean by snow, but
it's this white stuff falls from the sky every once
yes,
in a while.
I recall from my days in New York. Yes.
I know you were on Long Island for a long time, so you definitely know about snow also. Dr. Ellman, I am excited for our subject today. This is our 12th interview that you've done with us, sharing so much information on what we call the BCI, or you call the BCI strategy, which is the Blue Collar Investing Corporation. Again, anyone that wants to find Dr. Ellman, www.thebluecollarinvestor.com is how to do that. And Dr. Ellman has been doing this for over 30 years, covered calls, teaching it for over 25 years or so, and brings so much information to us here at Quasar Markets Live, one of the pillars of our education system. So, Dr. Ellman, why don't you talk a little bit about what we're gonna go over today?
Well, we're going to talk about a covered call writing like strategy. It's not traditional covered call writing. It's a form of covered call writing where instead of first buying a stock or an exchange traded fund as the underlying security, instead you buy a leaps option. Now that's a long-term expiring option. It's usually out anywhere from 1 to 2 years, sometimes beyond that. And the reason that investors are interested in purchasing the leaps option, which gives you the right to buy the stock at a certain price by a certain date, is that it's cheaper than buying the stock or ETF itself. Also, the particular strike price that's selected is a deep in the money leap. So in other words, much lower than current market value. And the reason for that has to do with something known as delta. And delta is the amount that the value of that option premium moves for every $1 movement in the price of the stock or ETF. So the deeper in the money you go, the lower you go from the current market value, the higher the delta, which means that the very low, deep in the money strikes will have a similar price movement as the stock itself. So
Right.
In today's presentation, I'm going to demonstrate how to select what strike price to use when we're crafting our trades for the poor man's covered call. So cheaper, it's a longer term investment strategy, and it's also one that can generate very, very nice returns. But there are some caveats to the strategy that we can discuss as we go along.
Absolutely. It's something I've interested. I've used it. And one of the reasons I wanted to go over it with you is that there are a lot of nuances to it that people don't understand. It isn't as easy as some people will make it seem, especially on the internet. One of the things we do here at Quasar Markets is we try to level that playing field. We're trying to let the retail trader know the secrets or some of the trading strategies that are used by institutions and larger investors and how that affects that. Hold it 1 second, Dr. Ellman. I'm sorry, my dad got a delivery here in the middle of this. So I'm going to come back. I'm going to start that section again so that I can do it. Hold it 1 second. Dad, can you?
I can't help that.
What I need you to do is open the microwave and shut it so that it doesn't keep beeping what it just did.
Oh, I'm sorry.
Thank you so much, sir. That is great. You got an 87-year-old father. I don't want to give him too much credit.
Tell him I said he should be very proud of his son.
You hear that, Dad? He said you should be proud of me.
I am. Okay. He's not yelling at me.
Yeah, see, and that he calls yelling at him, by the way, Dr. Ellman. So if the police ask you for a reference, this would be why. He calls that, elderly abuse.
I won't report you.
Thanks. Okay, 5, 4. I'm going to take a drink too, actually.
Are we starting over or just at some point?
No, I'll cut it. What we'll do is we're going to go right into the actual presentation. So I'll say again why why I thought this was important, and then go right into it.
Okay.
Yeah, that's why I thought this was so important to bring to our newer viewers. We try to level the field here at Quasar Market to give some of the insights that institutional and more seasoned veteran traders are using, and techniques that they're using, and strategies. And I do think this is one that it isn't extremely hard to learn, but you do have to know the nuances. Otherwise, you're not going to get the right entries, and you won't see a profit, even if the stock moves in the way that you thought it might. So let's get right into your presentation.
So if we were to define the poor man's covered call, which in essence I already did, it's a covered call writing like strategy where we're going to use leaps options instead of stocks or ETFs. Now, leaps have expirations greater than a year, 9 months to 2.5 years out. And if we purchase that leaps option, once again, giving us the right to purchase the shares at a certain price, that's the strike price, by a certain date, the expiration date, which is far dated, then we can then write short-term covered calls against that long position. So we're long the leaps option, we own it, and we're short the covered call, which in all forms of covered call writing, it's known as a short call because we're contractually obligated to sell our shares at the strike price by the expiration date. So when we're calculating our returns, the returns will be higher because the denominator, the price of the stock versus the price of the leaps, will be smaller. So in essence, the returns will appear greater with the poor man's covered call. So that's the second attraction of the strategy, less cost to enter the trade, and then from a percentile perspective, a greater percent return. So what are we looking to get? For traditional, you might opt for 1 to 3%. I go 2 to 4% in mine. It depends on how much risk you're willing to incur, but usually it'll be greater. And by the way, that meant for per month. It'll be greater for leaps because the denominator is smaller. The cost of the leaps is less than that of the stock.
Absolutely.
So one of the factors that will determine the appropriate strike price that we're going to select for the leaps option, because how do you know how to craft the trade? How do you know which leaps to pick? How do you know which short call to pick? And that all starts at the very beginning when you're crafting your trade. So in a slide or two, your viewers are going to see a spreadsheet that I created, which will actually let you know whether it's an appropriate poor man's covered call trade from the perspective of the following. And I hope that your viewers can follow me on this. But let's say, for example, you enter a trade and the price of the stock is, let's say, 50. And then all of a sudden, some good news comes out about the company and it goes to 80. Well, you may have had a 55 call strike in place, and now it's at 80. To buy it back, you're going to have to spend a fortune to buy it back, and you may not want to do that. So what's going to happen is you're going to close the trade, and it might actually close automatically, because if the call buyer exercises it, then your broker is going to exercise the leaps and sell the leaps to the call buyer. So auto exercise is possible when the price of the stock goes to the moon. It's not going to happen a lot, but at least you know when you enter the trade that you're protected against that. In other words, you're not going to have to close it at a loss. You're going to close it at a gain. So one of the things you have to look at is how much time value are you paying for that leaps option? And the takeaway from this slide to your viewers is the following. The deeper in the money you go, the lower and lower and lower you go, getting further and further away from that stock price, the smaller the time value component of that leaps option premium is going to be. So if you select the leaps option, let's say not that much lower, the time value may be still pretty high. And if you're forced to close that trade, you may be forced to close it at a loss. So you may have to go lower to a lower strike, which has a lower time value component. Now, the tricky part is the deeper you go into the leaps, strike-wise, the more money you're going to pay, because the intrinsic value is greater, but the time value will be less. And hopefully there'll be some clarity on this point as I show you a real-life example with Apple that's coming up shortly.
Absolutely. It will definitely be easier when you can see it and you have the numbers in front of you. But that's what I was talking about how important it is and why I think many newer retail traders fail in this technique is they don't quite fully understand the leaps. I've seen people do it a lot of different ways incorrectly over the years that they've come to us when I was at Prosper and said, how do I trade out of this? Because they didn't do this part correctly. So I do think it is so important to understand, like you're saying.
So to figure out, and once again, I just want to repeat to your viewers that we're concerned when we enter the trade. What if the price of the stock goes to the moon and auto exercise occurs, or we're forced to close the trade because we can't put much more money into the trade? So how we guarantee? So I created this formula that's inherent in the spreadsheets that you're going to be seeing soon, and it goes as follows. The difference between the two strikes, okay, the short call strike, which is out of the money, a little bit higher than current market value, as you'll be seeing, and the leap strike, the price that we're allowed to buy the shares for by buying the leaps, the difference between those two strikes plus the initial time value profit on your first trade must be greater than the price we pay, the ask price of the leaps option. And if we adhere to that formula, which once again is inherent in our spreadsheet, so for those that have my spreadsheet, you don't really have to memorize the formula, although it's not a bad thing to do because it's in there. So
but it is important. So many people, like I said, I had over the years come to me and say, hey, why is this not profitable? I thought it would be. And the biggest part is they didn't use this formula. They don't have the right difference between the two strikes, and they didn't cover that with the initial short call premium. And what happens? They end up on the wrong side of the trade. So this is great.
So this is an example taken either from one of the articles I've written. I lose a little track because I've written over 700 articles over the years. And it may have come from one of my books. But in any case, this is a good example for what we're discussing now. That it doesn't show the trade date, but it was 3/27, and it's for the 4/21 expiration. So less than a month. At the time, Apple was trading at 160.20. So we're looking at the short calls now, the covered call. And if you look at the 162.50 out of the money strike, higher than current market value, and you go to the bid column, you'll see there's a bid price of $3.60. So for every contract we sell, we're generating $360. So that's the short leg of the PMCC trade. And now if we go to the next slide, we could look at the leaps option. And what I put up here, Howard, was two different leaps option strike prices. Let's start with the yellow cells with the 80 leap strike. Now, once again, just as a reminder, we're using only deep in the money leaps because they have a high delta, which means they'll simulate the price movement of the stock itself. The deeper in the money we go, the higher the delta, the closer it will mirror the price movement of the stock. So let's first look at the 80 leaps option. We're buying it now, so we don't look at the bid column. Look at the yellow cell right in the middle of the screenshot. We're going to look at the ask column, which shows a price of $87.75 per share. So instead of spending $160 for Apple, we'd be spending $87 per share for the leaps option. So the denominator is smaller, the percent return is greater, and the cost to enter the trade is less. So that's one strike. Now, the other strike, if that doesn't work, we can go to the 60 strike. Now, of course, you could do the ones in between also. I just wanted to show you two of them. The second one is the 60 strike, which you could see has a bid price of $102.95. So you're spending more for it. But if the 80 doesn't work, then we're going to try the 60. And by the way, if you look at the delta, it's 0.9, it's 98. So it's almost precisely simulates the movement of the price of the stock. The 80 also is pretty good, almost 96. So 96, both of them simulate the price movement of the stock. So in other words, it's a surrogate. The leaps is a stock surrogate. It's cheaper. and yet the price movement will be pretty close to the price movement of Apple at the time that this screenshot was made. So there we
Right.
have it. We're going to put into the spreadsheet 80 first, see if that works, and if it doesn't, well, it won't. Then we'll go to 60. Otherwise, I wouldn't have used those two as an example.
Right.
Okay, so let's move on now. Here's the spreadsheet, and I hope that your viewers can read it. Kind of looks a little.
Yeah, it looks perfect.
Yeah. Okay. Good. So here we have it. You could see on the top here, we put in the information on Apple, what it was trading for at the time, the 80 leaps, $87, and where am I? 75 cents. And we enter that information from the option chain into the white cells. That's all you have to do. The date,
Okay.
the expiration date, and of the leaps, of the short call, and so on. Now, if you move to the green cells at the bottom, that's the meat and potatoes of these calculations. Once again, the formula, the difference between the strikes plus the short call premium must be greater than the cost of the leaps option, the 87.75. Well, in this particular case, it turns out that it's minus $1.65 per share. So it's a losing trade. And therefore,
Right.
the spreadsheet will show us a big, bold, red no.
I love it. Very important.
Can it
It's
be
hard to
any
miss
easier-
that one
can
even
it
with
be
my
any
glasses.
easier than that? It can't be any easier than that. So you say, okay, well, that means the time value was a little bit too high on the 80. So if we go deeper in the money, yep, it'll cost us more, but at least we'll be protected in case we have to close the trade. So let's try the 60 strike and see how that works out. All right, so now we're using the 60 strike, and you had to pay $105 instead of $88, but the time value component is lower. And lo and behold, if we're forced to close the trade, we close at a credit of 90 cents a share, $90 a contract. So therefore, in the event that the price of Apple goes to the moon and we're forced to close the trade because we don't want to add a lot more cash to the trade in the form of intrinsic value, in that case, the spreadsheet will show us a big, bold yes, it's appropriate to enter the poor man's covered call using this strike. Now, you can also try, it only take a few seconds, the strikes in between. And, you might get one that says no and one that says yes, but at least you'll know it's appropriate.
Absolutely.
You might be able to get into the trade a little bit cheaper. So,
Right.
This spreadsheet, though, will make it so easy as far as entering the trade. And then there's, I'm not showing it in this presentation, but there are 4 other tabs for managing the trade once you enter it.
Oh, wow. Yeah, I mean, and that is, I stress it on every one of these calls. You and your team at the Blue Collar Investing Corp have made this so, I don't want to use the word easy because that makes traders, it gives the wrong appearance to traders. But what it does is you've taken a lot of the homework and made it simpler so that you can get to your answers or to what your decisions are in a lot quicker way. Like you said, otherwise, personally, I would have been staring at option chains. I'd have my little notepad that I have here, and I'd be spending the next hour with a calculator going through each part of the option chain to do it. And that's what I want to take across and why people should get involved with the Blue Collar Investor if this is the type of thing that you're trading, because when it comes to covered calls, when it comes to cash secured puts, you guys have systems in place, years and years of experience on it, and you've made it pretty much click and choose, so to speak.
Yeah, I used to do it when I first started teaching myself these strategies back in the mid 1990s. And I used to have to put all that kind of time and effort into it. And then over the years, I've streamlined it. And that's what I'm sharing with the BCI community, with the Quasar community. And I speak all over the country on these strategies. So, a lot of this stuff is very intimidating. I know it was for me when I started teaching myself these strategies. But once you kind of get into a role and you start doing it more and more, it's like reading a price chart. Wow,
Yep.
well, look at these lines all over the place. What the heck do they mean? It's you almost like, forget it, I can never do this. But then once you've looked at a few dozen charts and you kind of set up the parameters the same for each stock, well, you could read a price chart in like 3 seconds and go, okay, bullish, neutral or bearish.
Yeah,
So
it's funny you say that because I can remember when I first started, with Big Beat, and he was doing these, educational stuff for us during COVID. A lot of people and trying to help people, and he would go through a chart, and it would be boom, 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 and I was like, What just happened?" And it took a couple of years, but now it is funny because the same thing. Yeah, someone can just rattle off a number, a ticker to me. I can look at it in 30 seconds and give them. Well, these are the pivot points I'm looking at. This is my expected trading range. It is amazing how these things come. And I have to say, just in using the calculators you've shared with me, graciously, you've made it so that I understand this stuff so much better than I did just a couple of months ago.
Yeah, not only having the spreadsheets is definitely a godsend for sure, but understanding why the spreadsheets give these particular results will make you an even better investor. And it's kind of like learning, back in algebra in college, high school, whenever we took it. I mean, they could give you a formula, but then they'll start asking questions. If John walks 6 miles this way and then comes back 3 miles, and then you can apply that formula in all different circumstances if you understand the rationale behind it. So that's what we provide, and you and I are on the same page when it comes to educating investors so that they can achieve the highest possible levels of returns.
Absolutely. That's the goal. And, you've been doing it for years with these, products that you use, and really, again, giving people that leg up. That's why I bring it up so much. And I got to tell you, what I use on your website more than anything, quite honestly, is your blog. I mean, you mentioned 700 something articles. They're all pretty much there. I'll go there when I just got a little time and say, okay, what subject do I want to look at today? Oh, look, and that's how I found this, this discussion. Oh, he's got something on leaps. Let me see what he went over. Oh, this is perfect. This is exactly what we're trying to get across to our investors. So again, those are all, you guys offer that for free. I'm still blown away. Again, I worked for Prosper, and to get to that level cost you something. So the fact that you guys do share this stuff is awesome. And, I definitely, again, I tell everybody, take advantage of all the free tools that you are provided, whether it be from the Blue Collar Investor, whether it be from Quasar Markets, whether it be Market Watch and CNBC. I don't care who gives it to you. There are, some people that are nice enough to share some really good information, and you want to take advantage of it when you can.
The feedback and the testimonials is priceless.
Oh, yeah, absolutely.
So, to kind of summarize, but then I'm gonna give you the other side of the coin also, because I always do that. All right. So in terms of establishing your poor man's covered call trade, you really should adhere to the trade initialization formula that I alluded to in this presentation. So the spreadsheet, for those of you viewers that have or will get my spreadsheet, the spreadsheet has that formula inherent in it. If you don't have it or you don't plan to get it, just go back and review the actual formula that I gave. I'll give it to you again now. The difference between the two strikes plus the short call premium must be greater than the cost of the leaps. Not that difficult. So, for those that don't have or won't get the spreadsheet, there you go. And then you could calculate it for yourself. Now, the one thing, and I'm sure you know this, Howard, if you go onto the internet and you kind of Google search or however search the poor man's covered call, you're going to get something like this: covered call writing, but cheaper. All right. And then people go, hey, why should I just do traditional covered call writing where it costs more to enter a trade and I get higher percentile returns because the denominator is smaller in a poor man's covered call? Why bother with traditional covered call writing? Here's why. First of all, there are a lot of moving parts to the poor man's covered call. In one of my books, Covered Call Writing Alternative Strategies, half that book is dedicated to the poor man's covered call. And a big section of it is all the moving parts that are associated. So let me just throw a couple so your viewers can factor this in when they're making a determination. Is this the right strategy for me and my family?
Absolutely.
First of all, when you own a stock, you own that stock, right? I mean, you just keep on owning it. I mean, a couple do end up bankruptcy, but for the most part, stocks just go on. But when you buy a leaps option, it does have an expiration date and eventually it goes away. So how do you deal with that? Well, you deal with it by rolling the option. Now, my suggestion is to roll the option 90 days before contract expiration. So, okay, so when you buy back the leaps and you sell it and then buy a new one, that's going to cost you some money, about $2 to $3 a share. I kind of figured that out. I tried a whole bunch of them back in the day. It's about $2 to $3 a share. Where's that money coming from? So you have to have a cash reserve at the 90 days prior, if you do it my way, 90 days prior to expiration of the leaps to then roll that leaps option. That's one of the moving parts that a lot of people don't consider. Second, why did we pick that stock, right? We picked that stock because we had a bullish assumption of that security at the time that we entered the trade. Right. So maybe there'd come a time when everything changes, like all the parameters that we use for selecting it is not there anymore. As a matter of fact, it may look ugly at this point in time. So even though it's a long-term strategy, if you're doing short-term covered calls, traditionally, you could reevaluate your bullish assumption every week. If you're doing weekly,
absolutely,
every month, doing monthly. That's what I love about covered call writing and selling cash secured puts, is you could reevaluate your bullish assumptions so frequently. Okay. Also, and we've talked about this many times, Howard, when you're doing long-term strategies, you're going through earnings report after earnings report after earnings report. And as you know, and you've seen, I'm sure, many times, an earnings report could just ravage the price of the stock if it disappoints. And absolutely. So you're incurring the risk of earnings reports 4 times a year, which I personally don't like. It's one of the risks of this approach to covered call writing that you don't have with traditional, where you're circumventing earnings report.
And in theory, to me, to a point too, I love the 2 revenue streams that owning the stock provide, because the appreciation of the actual stock price, if you do have the bullish, view, like you said, is also going to appreciate during that time also. And like you said, there's a lot of moving parts that people sometimes don't realize with options that come into play with this. And one of the big ones, like you've talked about, is, you don't necessarily own anything with the option. You own the right or the obligation to do something. You don't own the underlying equity at that point.
And for that very reason, Howard, since you don't own it, if there is going to be 4 dividend distributions over the year, you get that with the stock. You don't get that with the leaps option. And I could think of offhand one more disadvantage of this strategy. So I want to be as thorough as I can, but there are more in the book. And that is, obviously, you have to deal with stocks that have leaps options associated with them. And that pool of securities is much, much smaller than stocks that have monthlies and weeklies. So, the selection of securities is much less, much smaller. I mean, certainly you could find good quality securities, but I think your viewers should understand that pool is much smaller with the poor man's covered call.
Absolutely. And that is important, because one of the things we talked about and have talked about a few times on our things is how many stocks there are out there that do fit the criteria for doing covered calls or cash secured puts on a weekly or monthly basis that you guys share with your clients. So, this does become a smaller pool, so to speak, with it for sure. But I did want to bring it out, because I do think having all the sort of, arrows in your quiver are important, and it definitely is a tool that is viable. And for some people, definitely a decent way to, maybe get into for the first time, covered calls at a little bit of a lesser expense. I do want to point out, though, it is still expensive sometimes for these stocks, like the example you used with Apple. It was still a pretty big, significant, investment to get in. But it does cut that cost a little bit. And again, just, we want to teach people all the different tools that they can use to maximize their investments.
But if your viewers select a stock that's priced much lower than Apple, then the cost to get into the trade will be that much lower, even using the formula covered call. It'll be significantly. If you pick a $50 stock, the cost to enter is going to be dramatically less than what I showed in this presentation. I used Apple because everybody knows Apple.
Absolutely. No, and you're right. And there are definitely ones that, and that very good point to point out that I didn't say, because Apple obviously being one of the most valuable stocks in the stock market, and one that trades at a multiple of 160 or above, it is expensive to use in any sort of strategy as compared to something that maybe is trading at $10 or $12 for sure.
I just did some research. This is just a fun fact here. I just did some research for a case that I'm working on, and Apple, since its IPO, has gone up almost 40,000%.
It's insane.
I thought that was amazing.
Yeah, I mean, and it's not stopping. The question now, though, is I'll have to ask you. We talk about it a lot on our 9 to 10 o'clock show with our guests. What becomes the first $4 trillion company? Are you betting on Nvidia, Apple, or the rest of the market?
I'll tell you, with AI, I probably would. I mean, if gun to head, I'd probably go with Nvidia. What do you think?
That's the one most people are picking. That's Steve and I, Big Beat and I, are definitely in on the Nvidia one. In fact, he's calling for it to be a $4 trillion company by October. The pullback the last few days has not helped his thesis there very much.
It might have some competition from Quasar. I'm not sure.
We can only hope there. We're a while away from our IPO there, Dr. Ellman, but we will definitely get there. I have no doubt someday soon. Thank you so much for joining us. Like always, it's so helpful to be able to bring a professional like yourself on weekly and to show these strategies and teach our viewers how to be better traders. So thank you so much again.
I love and appreciate our discussions, Howard. Take care.
Okay.